Hello, this is Domenico with Easynomics, and in this video we're going to continue going through a Paper 2 type of exam. There have been a few videos that have been breaking down this Paper 2 type of exam, which will be linked in the video notes below. First, we looked at the inelasticity of demand for crude oil and how changes in price relate to total revenue. Then we looked at the supply curve for oil-producing firms and why it's inelastic. And then we put the two together, supply and demand, and illustrated rising demand as nations came out of the COVID lockdown and expected as we approached the summer of 2022, rising demand for gasoline as people began to travel by car, by plane, and so forth. In this video, we're going to go over a collusive oligopoly. Just as we've done in the previous videos, we've been referring to this article. So paper 2 is a quite useful exam because it allows us to use our economic toolbox of models and apply them into the real world using these database type of questions and applying the models in the context of a real world situation. And it also helps with kind of cataloging real world examples that you would need for a paper 1 part B question, because it will ask you to apply a real world example. So we're going to go back and use this example of OPEC plus and the impact of rising prices for crude oil and gasoline as a result of the Russo-Ukrainian War, etc. We've seen in previous videos the volatility of oil prices and essentially any type of primary commodity. If we look at any primary commodity, we'll see that prices are very volatile, constantly changing each day. Here we have this dramatic drop in oil prices as we entered the COVID pandemic, and there was also coincidentally a price war between Saudi Arabia and Russia that led to that dramatic drop, and then it recovered and started to rise. And then here we're beginning to come out of the pandemic. We're coming out of the pandemic. Things are looking good. Demand is increasing, and then we have the Russo-Ukrainian War. All right, so right here, February, March, we see a dramatic increase in the price of crude oil as a result of sanctions on Russia. Russia, as an exporter of crude oil, less supply of Russian oil into the world market. That reduced supply will drive prices up. And then as we enter May into June, there's the expectation that there's going to be rising demand for gasoline as people begin to travel into the summer holiday. And so that's the period in which this article is referring to, this expectation that demand is going to increase as we get into the summer. And so we're going to look at that in this video. This video is going to look at illustrating a collusive oligopoly, and a collusive oligopoly is a monopoly or a collective monopoly. So the article is referring to OPEC, particularly OPEC plus. This is very important as an econ student, whether in high school or at the university level. You should know this organization, the Organization of the Petroleum Exporting Countries. It's a collusive oligopoly of participating nations meeting, I believe, twice a year in their headquarters in Vienna, Austria, to decide on the global supply, or to determine their collective supply to impact the global supply market so that they can influence price for this primary commodity. Recently in 2022, just recently in October 2022, OPEC Plus, and OPEC Plus includes, do I have those members nations here? I think, yeah, further below. I'll show you the list of those nations. Led by Saudi Arabia, announced reductions in oil supply to maintain a higher price. Of course, as we're dealing with levels of demand pull inflation, cost push inflation, as we exit the pandemic and face the reductions in food exports and energy exports during the Russian-Ukrainian war, everyone's feeling the impact of inflation, and energy is a big fundamental input for the inflation that we're feeling. Everything directly or indirectly is tied to energy. And so this reduction in supplies of oil was very upsetting to developed nations, if not all nations, as we're all facing inflation. These are the member nations of OPEC, as we can see here. And in terms of the oil production, we can see that the biggest oil producer is Saudi Arabia. So essentially, they are the market leader of this collusive oligopoly. They have the power to discipline member nations if they break agreements just because of the volume of output that they're able to generate. And collectively, it says here that they contribute as an organization about 44% of the global oil market, significant um, market share within the world market. And collectively, they have 73% of the proven oil reserves around the world. OPEC Plus includes members, non-OPEC members that can participate in these voluntary supply cuts. They include Azerbaijan, Bahrain, Brunei, Kazakhstan, Malaysia, Mexico, Oman, the Philippines, Russia is a big one, and South Sudan and Sudan. Great. So let's tackle the question. So in this paper 2 question, we've graphed this model here, market demand in relation to total revenue, market supply, supply and demand put together. So we're going to look at question D and illustrate a collusive oligopoly. It says here, using a collusive oligopoly monopoly model, illustrate OPEC plus. Okay, fine. Let's see if I can highlight that. Oops. Illustrate OPEC plus as that collusive oligopoly real-world example. And in our analysis, discuss price, costs, quantity of output, allocative and productive efficiency outcomes. And then we can refer to text A, paragraphs 1, 2, 3, and 4. Okay. So let me just outline that. Here we go. So let's go back. So going back to that Bloomberg article, here are some snippets here. And we've dissected this in previous videos. Scarcity of refining capacity, physical impediments to that are difficult for the producers to solve, no refining capacity. Those are determinants of the elasticity of supply. So the supply curve is going to be very inelastic. Demand for crude oil, as we know, as a primary commodity is very inelastic. And here it's saying this rising demand, which we don't need to illustrate. But in the next video after this, I'll show rising demand on a monopoly model to show what happens to profit and total revenue. So let's go ahead and illustrate this. All right, so here we have our model, graph D in this exam. We're labeling it differently, A, B, C, D, so we can refer to each graph in our evaluation. And we'll label this as profit maximization by a collusive oligopoly, particularly OPEC plus. OPEC plus is a collusive oligopoly example. In this collusive oligopoly, we have firms, or in this case, exporting nations, that are agreeing to collude by agreeing to limit their competition between each other. Collusion is illegal in most nations because it limits competition and it keeps prices high, which negatively impacts households and consumers. A cartel, specifically, is a formal agreement between firms, or in this case, exporting nations, in an industry. And this industry we're looking at is the crude oil market. And they're colluding and working together to limit competition between the member firms or countries, to fix prices, reduce supply to raise price, and increase profits to benefit themselves. Benefits to firms in participating in a cartel include greater collective market power to control price, greater supernormal profit, elimination of competition between members, which reduces the risk of price wars, etc. So there's a lot to gain, but the majority of consumers all are negatively impacted by this. So how do we draw this? My recommendation for drawing a monopoly or collusive oligopoly is first draw the supply curve. We're going to draw the supply, taking into account that there is this marginal costs are initially falling according to the law of diminishing returns, then it starts to rise. As we add variable inputs to fixed resources, the marginal cost of production increase. So it has this backward J shape. We're going to label that S1, and it's equal to our marginal costs of production. Then we're going to label or draw our average total cost curve, ATC. We'll have it coming down to a particular point. the moment it intersects the supply curve, it has to start moving up. And there are other videos that explain why that is the case. What's the relationship between the marginal cost and the average cost curve? So it has to be drawn this way, where ATC comes down, it hits the supply curve, and then immediately it goes up. If you don't do that, you're likely going to lose a point in your drawing of the model. So let's label this the average total cost curve, ATC. Costs on average for producing outputs. Okay, so I first draw this, and then I will draw my demand and marginal revenue curve. And the supply curve is relatively inelastic, and the demand curve is also going to be relatively inelastic. So here I have my demand curve, and I'm going to draw it above this particular point. And I'm going to label that D1 is equal to the marginal benefits. And then I'll draw my marginal revenue curve. And I'm going to draw it below this point here. And I might as well just draw it going below 0. Okay, so that's my marginal revenue curve, MR1. All right, so we have drawn this model. We want to keep in mind that we're going to assume, the assumption is that the firm's objective, or the collective firms or collective exporting nations, part of this collective oligopoly, firm's objective is not to maximize revenue. We're going to assume that they're going to maximize profit. So maximize profit. And there's a rule in economics to maximize profits is to set output where the marginal revenue is equal to the marginal cost. You absolutely need to know this. So let's look for that intersection. Here's the marginal cost curve. Here's the marginal revenue curve. And they intersect right here at this point. So that's going to set my output. So I'm going to draw a vertical line downward, setting output here. This would be quantity. I'll just label this Q1. And then they'll price according to their inelastic demand curve right here. There's the demand. Oops. And so here we can illustrate the price that they're going to charge. And I can label that P1, which is equal to the average revenue, AR1. And we're going to remember that demand equals marginal benefit also equals average revenue. Fine. What about the costs of production? Cost on average is right here at this point. Okay, so right here at this point, we see the costs of production. So this is going to be C1, which I can also say it's equal to the average total cost value. Now I'm going to shade in this boxed area so I can see the supernormal profit that's being generated by the firm. And essentially I'm done. I'm going to label a couple other points to help me with my analysis. So I'm going to label this point here to remember that this is my marginal benefit at that level of output. And here's my marginal cost. Here's my supply curve, my marginal cost at this level of output. So we can see that the MB is greater than the MC, so welfare loss, there's an under allocation. So I can also shade in, if I want to see this area. Here is the welfare loss generated by this collusive oligopoly, this cartel. There's the welfare loss. Okay, great. So let's go ahead and analyze this as we would for this paper exam. As can be seen in graph D, we're illustrating a collusive oligopoly, particularly OPEC plus, seeking to maximize profit. On the y-axis, we're measuring price, costs, and revenue. And on the x-axis, we're measuring the quantity of output. We have two downward sloping revenue curves according to the law of demand. We have one labeled D1 equal to the marginal benefit, which is also equal to our average revenue. And we also have a marginal revenue curve that's downward sloping labeled MR. MR is less than AR because we're going to assume that the firm is not price discriminating. All right. So a quick way to explain why AR is greater than MR, because we assume that the firms in this collusive oligopoly do not price discriminate. And I have other videos that explain that, and I'll have those links as well. Okay. So we have that explanation. We have an upward sloping supply curve labeled S1, upward sloping according to the law of supply, and it's equal to our marginal costs of production. And the supply curve S1 intersects ATC at its lowest point. The average total cost curve slopes downward until it intersects with the supply curve, and then it slopes upward after it intersects with the supply curve. Fine. Assuming that the objective of the firms in this collusive oligopoly is to maximize profit, they'll produce where MR equals MC, which sets output at Q1. At Q1, the firm will price according to their inelastic demand curve. And we remember that the demand curve is inelastic. It's less than 1 because there's no close substitute. So they set output at Q1. They price according to their demand curve, establishing a price of P1, which is equal to average revenue. And we see that quantity 1, average total costs, is at C1, which is our ATC curve. Since price is greater than costs of production at Q1, or since AR, average revenue, is greater than the average total costs at Q1, the firm is generating supernormal profit, which can be seen by the shaded green boxed area. So I've analyzed the model. Now I'm going to just briefly explain the impacts on allocative and productive efficiency to answer that question. At Q1, we see that the marginal benefit is greater than the marginal cost. Thus, the collective oligopoly or collusive oligopoly is underallocating resources to the production of crude oil versus what is desired by society. Society would like more crude oil being produced and exported, but it's not. So there's an underallocation of resources to the production of crude oil versus what is desired by society. In addition, we know that at Q1, the average total cost curve is greater than minimum average total cost. So since this point here is greater than this point, that signals that the collective oligopoly is productively inefficient. So this collective oligopoly is allocatively inefficient. So this means here it's allocatively inefficient. And it is productively inefficient at this level of output of Q1. We've talked about price, we've talked about costs, we've talked about productive and allocative efficiency. So we have answered this question. Collusive oligopoly, we've drawn it, we've discussed price, we've discussed cost, we've discussed quantity of output at profit maximization, we've discussed allocative and productive efficiency. So we've effectively answered that question. All right, great. So that's it. In the next video, we'll answer this question here about using an indirect tax. And so on. There'll be some other videos dissecting this particular article, but there you have it. All right. There'll be a bunch of links to other video tutorials on this idea of price discrimination, why is AR greater than MR, profit maximization, productive and allocative efficiency in the context of a monopoly, and so on. In the next video, I'll probably draw an example of again using this, but then illustrating what happens when demand increases. What happens to supernormal profit? We're going to just draw that and illustrate what's happening in the real world as demand was rising for gasoline as we got into the summer holidays over 2022. And that's it. If you have any questions, feel free to comment those questions below, and don't forget to subscribe and to like. Thank you so much.